Welcome to the Money Master Unleashed podcast. I'm your host, Adam Olsen, with you today. In today's episode, I'm going to give you some retirement income strategies, and then I'm going to walk you through how you can use these retirement income strategies to really ensure your financial security during your golden retirement years. You see, I've been a financial planner with Mutual of Omaha for over a decade now. And as a financial planner with them, I've used these strategies to help hundreds of clients successfully retire. And these are the most important things that I'm going to go through today in this video with you that you need to use to really help you secure your golden retirement years. You see, a lot of people think about what they're going to be doing in retirement, but they don't take into account really how their income is going to be created and where the income is going to be coming from. So you need to have a retirement income plan. Yes, that's first and foremost. But you also need to evaluate that plan more than just once every year, and then you need to adjust that plan more than once every year for life changes that you have and market changes that we have in our financial markets. You see, life is ever evolving, the markets are ever evolving, interest rates are always changing, and if you're not staying up to date with your current strategy, you could be falling behind and missing potential income opportunities on the table. So work with a financial planner and make sure that you create one of these retirement income plans to make sure that you're getting the most out of your retirement years. So first, before we get into really the nuts and bolts of today's episode, I want to talk to you guys about what exactly is retirement income planning. Well, honestly, this is really the most important part of your retirement plan is where is our income going to be coming from and how is it going to be coming into us? You see, you've worked your entire life and you've got a paycheck every single month or maybe every couple weeks or maybe every week while you've been working. So why would you change that in retirement time? You see, a lot of people don't set up paychecks for themselves in retirement, and they really feel strapped from a financial standpoint. So when I'm working with my clients on a retirement income plan, we structure paychecks to you every 2 weeks. So every 2 weeks inside of your bank account and our retirement income strategies that we use, you're getting a paycheck. And guess what? Just like during your working years, you get to spend that paycheck on what you want and what you need. Now, we give you guide rails for you to stay inside of to make sure that we don't run out of money over the long term. So just like you did during your working years, you're going to have a paycheck in retirement for you to live life on your own terms. That is the most important part of your retirement income plan. Being strapped in retirement is the last thing that you want to do. Structuring a proper retirement income plan will give you freedom and flexibility for your lifestyle in retirement. And it'll allow you to make sure that your bills get paid on time and that you're taking full advantage of all of the interest-bearing accounts that we have to offer you. So let's get into his retirement income plan, really how we set it up. How does this thing work? Well, first and foremost, we need to think about how much you're going to need in retirement. And we do that by evaluating expenses, budgets, credit card statements, bank accounts, so on and so forth. Now, at this first step, we need to actually look at this. So don't just estimate it. Don't just think, hey, I spend $2,000 or $5,000 or $10,000 a month. Actually look and figure it out. Here's a great example for you. I was just in a client meeting last week, and this client initially said that, we have about $3,500 a month in expenses. So we really dug into their plan in the next meeting. I had them bring all their bank accounts, all their credit card statements, every single thing that was coming in and out of their bank account they brought in. And once we dug into this, they were actually spending about $5,500 a month, not $3,500 a month. So that could have drastically changed how much money they needed for retirement, not only from an accumulation standpoint, also from a distribution standpoint. If we would have underestimated their expenses by $2,000 a month, that could have been a fatal retirement income planning error on our part. So make sure that you're actually looking at how much income that you're going to need in retirement. And I break income down into two things: fixed expenses. On fixed expenses over here, we're going to have things like housing, food, shelter, clothing, your bare necessities over here, okay? And then on the other side, we have variable sources. So that's going to be like leisure, entertainment, travel, these kind of things that might not be a constant month in, month out. And when we're designing our retirement income plan, I have these fixed expenses covered by fixed accounts: Social Security, pensions, annuities. The variable sources we have are covered by variable accounts, such as brokerage, money market accounts, stock and bond portfolios, those kind of things. And always when we're creating our plans, I have at least 12 months cash of clients sitting in a money market account. That way, if the market declines rapidly, or if we have an unexpected expense that pops up, we have enough cash to do that without having to sell off our benefits. Now, let's dig into Social Security. Social Security is an essential part of your retirement income plan. I see far too many people just say, hey, I'm going to take Social Security when I'm eligible, or I'm going to take Social Security as soon as I retire. That's an okay way to do it, but there's always a better way to do it. So when we're looking at claiming Social Security, you need to think about that Social Security is a lifetime income tool. And you get cost of living adjustments with your Social Security, which means that it should keep up with inflation year over year. A common strategy that I use if I have a husband and wife that I'm doing a retirement income plan on is this. Say I have a wife's benefit that's $1,000 a month when she's 67, and the husband's benefit is $2,500 a month when he's 67. Well, what I like to do is I like to get that husband's benefit as high as possible. So if I can get that husband to wait from age 67 to wait till 70, he's going to get a higher benefit for his whole life. But then listen to this. If his wife outlives him, the wife will get the higher of the two benefits. So it's extremely important for you to think about Social Security. How are you going to get the most out of it? Oftentimes, that can be done by delaying the highest Social Security benefit for as long as possible, which is age 70. So think about Social Security inside of your retirement income plan. Let's talk about pensions and annuities. Remember, I just told you that we use fixed income sources to cover our fixed expenses in retirement. These fixed income sources that I'm talking about are pensions, Social Securities, and annuities. We design these to give you guaranteed lifetime income that you cannot outlive. You see, investment accounts like stock and bond portfolios, they cannot give you guarantees. They cannot give you lifetime income. Only those three things that I just talked about can. So make sure inside of your retirement income plan, fixed investment income sources such as Social Security, pensions, and annuities are used to cover those fixed expenses that you have each and every year. And then obviously, we have the variable sources covered by stock portfolios and bond portfolios. Now really, so we know how much we're going to need per month. We know that we're going to get it from different sources. But really, how do we take out of these accounts? Because you see a lot of clients out there that we work with, and you probably do too, you're going to have different type of accounts. You'll have pre-tax retirement accounts. You'll have tax-free or post-tax retirement accounts. And then you'll probably have some taxable brokerage type of accounts. So each and every year what we do with our clients is we really come up with an income plan. How much income are you going to need to spend this year? And then what we do is we help factor their taxes. So what's going to be coming from Social Security? What are you going to be getting in rental income from other sources? Do you have a pension and annuity income? So we figure out what their base income needs are from those sources. And then from there, we decide what we're going to pluck from different accounts. Because the more you take out of your pre-tax accounts, your tax rate's going to go up. The more you take out of taxable accounts, if you have gains inside of those accounts, you may have to realize some taxes there as well. In retirement time, it's not just the tax rate that you're paying that's going to affect you, because your Medicare premiums are also dictated based upon your taxable income. So you need to be extremely aware of not only how much you're pulling out, but where you're pulling it out from. I call this a dynamic income distribution plan. We're pulling from different buckets based upon your income needs and your tax situation year over year over year. And it's not just a set it and forget it strategy. These can drastically change year over year based upon your situation. You also need to take into account that our tax situation in the United States is probably going to be changing a little bit in 2026 and 2030. So just make sure you're working with your planner on a dynamic distribution strategy. So now that we know how we're going to take out, where it's going to be coming from, what are some different investment strategies that you can use? Well, so I already told you a little bit about that. We use quite a few lifetime income accounts. These are annuity accounts that you put money into, and it gives you a guaranteed lifetime income that you cannot use. With interest rates high, like they are here in 2024, this is an excellent strategy for you to look at implementing. In addition to that, we also use stock and bond portfolios for our clients to help cover some of their variable expenses. And remember, with these type of accounts, you never want to sell when they're low, you want to sell when they're high. Because of that, we always keep 12 months cash on hand that you can use in case of a market downturn for you to cover your living expenses month over month over month. And I always tell people that you should have different accounts should have different uses. So with our account clients, we have long range accounts that are invested aggressively and short range accounts that are invested conservatively. That way, if we have big swings in the long range account and we're not going to touch it for 20 years, it's not that big a deal. We can give it time to recover. I can't let you go until we talk about required minimum distributions here. So a required minimum distribution is at age 73, you're required to take out a certain percent from your pre-tax retirement accounts. And if you haven't been withdrawing from those, that can cause a pretty large tax liability for you. So in your 60s, we strongly encourage clients to start thinking about and planning for these RMDs. So we run simulations for clients showing them what these RMDs are going to be at age 73. And if it really spikes up your income drastically, we'll need to implement some strategies to potentially lower those RMDs. We can do that through a couple different strategies that I'll talk to you about in other videos that we'll be putting out here on this channel. So just make sure that you're staying tuned for more. If you want to research them on your own, I would encourage you to check out a qualified charitable distribution that you can start doing at age 70 and a half. And I would also encourage you to check out a qualified longevity annuity contract. Those are a couple things that you can do to lower those RMDs in the future. You can also think about doing Roth conversion strategies as well before you get to age 73. And I can't let you go again until we really hit home on healthcare cost and retirement. These are the last two things that I want to talk to you about. These RMDs that I just talked to you about, like I said, they can really shift you into a higher tax bracket, which could cause you to pay more in taxes, more on your Social Security benefit, and also affect your Medicare premiums. So please, year over year, make sure you're taking into account the tax liability that you're going to be using in retirement, and make sure that you're trying to level out those tax brackets over time. Lastly, I'm going to talk to you about healthcare costs in retirement. You see, not only do you have Medicare premiums at retirement time, you're going to have IRMA penalties, potentially if your income's too high. You're going to have a Medicare Advantage or a Medicare Supplement plan cost as well. And on top of that, you need to really plan for long-term care cost. You see, everything that I just talked to you guys about, it doesn't matter unless you have a plan in place to pay for your long-term care needs that you could potentially occur in retirement time. So make sure you're using that through protection, whether it's an insurance or maybe an investment strategy that you're utilizing to plan to pay for these long-term care costs. Just have a plan in place with your advisor to make sure you're taking into account this potential drastic increase in your expenses based upon long-term care needs. It could devastate not only your retirement plan, but also your spouse's retirement plan as well. And lastly, you need to have a sustainable withdrawal plan. So you can't take all of your money out in the first 5 years of retirement because then you won't have any left. So you need to have a plan in place about how long do we want this money to last? Is it 20 years, 30 years, maybe even more? I just did a video earlier in this series about sustainable withdrawal rates. I'd encourage you to check that out for more on this topic. So in this video, again, to recap it for you today, I'm talking about retirement income planning and how you can use this to secure your legacy to really live the best retirement life that you want. Well, first off, you need to know how much you need. We need to know where you're going to take it from and how you're going to cover these expenses. You're going to want to get guaranteed paychecks in retirement to cover the fixed cost. And then each and every week, every other week, however you structure it, make sure that you're getting a paycheck so it still feels like you're getting money coming in so you're not living a cash-strapped retirement. And please don't forget to think about income tax consequences year over year today, but also how those can be impacted by your RMDs in future years. This has been the Money Master Unleashed podcast, and I've been talking to you today about retirement income strategies. If you want to book a call with me, I'd encourage you to check out my website. It's adamolsen.biz. You can go check me out there, and you can also book a call with me where we can go over your current distribution plan or how we can structure a new distribution plan for you to help you live your best retirement life. If you enjoyed this video or this episode, if you're listening on Apple Podcast, I would encourage you to subscribe to my channel. And if you found value in it, leave me a comment and let me know. Share it with somebody who would enjoy it. That would mean the world to me as well. I hope you guys have a great day and keep listening to this podcast for more information about how you can live your best life today. This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection lost against loss in a declining market. Purchase of life insurance is subject to meeting underwriting requirements. There is no guarantee of an individual will be insured. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax, and if taken prior to 59.5, a 10% federal penalty tax may apply. Guarantees are backed by the claims paying ability of the issuer and are subject to their terms and conditions.